In this video, we're exploring the question of whether you should use your home equity line of credit, or HELOC, as your emergency fund. Let's dive into the considerations, benefits, and risks involved in this financial decision. Let's quickly look at the agenda for today's video. We will talk about the core dilemma of using HELOC as an emergency fund, key considerations you need to keep in mind, a pros and cons analysis, and some personal recommendations. At the heart of the matter is the dilemma of minimizing HELOC interest by using your emergency fund to pay it down. While this strategy might seem appealing at first glance, it comes with its own set of risks. The question is whether the benefits exceed those risks. When considering using your HELOC as an emergency fund, first, think about liquidity. How quickly can you access your HELOC compared to a high-yield savings account, or HYSA? Then, compare the interest rates of your HELOC with the returns you earn from your emergency fund. Your financial stability also plays a major role, as it determines how secure your income might be. Don't forget to consider the renovation timeline if you're using the HELOC for an ongoing project. Lastly, be very clear about the HELOC terms, such as the conditions under which it can be revoked. Let's test your understanding with a quick quiz. What is the main risk associated with using a HELOC as an emergency fund? Your options are delayed access to funds, low interest rates, high liquidity, or no associated risk. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is delayed access to funds. A HELOC may not offer the instant access that a high-yield savings account provides, which could be problematic in emergencies. Let's take a closer look at the pros and cons of using a HELOC as an emergency fund. On the pro side, you could reduce the interest paid on the HELOC. However, this strategy comes with several cons. Accessing a HELOC is not as quick as a HYSA. Your home acts as collateral, meaning you could risk losing it. Banks can freeze or reduce your HELOC during economic downturns. And in an emergency, you would be adding debt rather than tapping into your savings. Here are some recommendations you can follow. First, maintain a minimum emergency fund, ideally keeping 3 to 6 months of living expenses in a high-yield savings account. Once your emergency fund is solidified, focus on aggressively paying down the HELOC. Lastly, continually assess your financial situation, making necessary adjustments as they arise. Let's look at the process involved in getting and using a HELOC. This flowchart shows that first, you start by getting a HELOC, which can be used for home renovation or considered as an emergency fund. If you choose it for emergencies, there are risks involved, such as delayed access and putting your home as collateral. However, if not used as an emergency option, it serves its safe and intended purpose. Today, we explored whether you should use your HELOC as an emergency fund. While this strategy could save on interest, it comes with significant risks, especially concerning liquidity. It's crucial to have quick access in emergencies. Always understand your financial situation thoroughly to make a well-informed decision. Thank you for watching. If you found this video helpful, please remember to like, share, and subscribe. We'd love to hear your thoughts in the comments below.